This is the first in a three-part series of resources on adjusting entries. Part 1 describes the reason we need adjusting entries. We then consider unrecorded transactions, both receivables and liabilities. Part 2 investigates prepaid expenses. Part 3 inspects unearned revenues. A general journal records all transactions as they occur chronologically. So long as we perform this analysis faithfully, why would we ever need to make any adjustments? Simply, it is because circumstances change. We can only make journal entries with the best information available at any given time. But certain expenses and other forms of transactions happen behind the scenes and are not so blatantly obvious. For example, if a company purchases a vehicle, it will lose value over time due to depreciation. But when and how should we account for that loss of value? The when is at the end of an accounting period. Most situations and entities call for these adjusting entries at the end of each month, although some may only occur annually. But what is the thought process for whether or not adjusting entries are needed? First, we need to look at all the various asset and liability accounts. Are all the balances correct, or were some transactions missed? Maybe circumstances dictate that something is not a transaction yet, i.e., the work has not been completed, or the money has not changed hands, but we still need to account for it. By inspecting the assets and liabilities, we ensure that our balance sheet is correct. Then we need to determine what adjustments are needed to revenue or expense accounts. This adjusts the income statement. It is important to note that the adjusting entries will affect one balance sheet account, an asset or liability, and at least one income statement account, revenues or expenses. One type of adjusting entry is an unrecorded receivable. These are situations where, because the work has been completed, and therefore can be recognized as revenue. However, the cash has not been collected, and a bill has not yet been sent. These transactions are often the result of a long-term contract. For example, suppose Polly's Plushies signed a contract to provide souvenir plush toys for the Spray Liquid Realm water park that is part of the Eight Banners amusement park. The year-long contract was for $6,000 was signed on December 1st. What adjusting entry is needed at the end of December, especially as the accountant prepares the year-end financial statements? Before we create the journal entry, let's do some analysis. First, we need to figure out what accounts are affected. Since the souvenirs have been produced and shipped throughout the month of December, Polly can recognize that revenue, which is the income statement account plus revenue. And since Polly needs to send a bill, that will go into accounts receivable. Both accounts will increase. Since the asset accounts receivable is increasing, that goes into the general journal as a debit. The revenue account is also increasing, so we enter that as a credit. The final thing we need to do is calculate the amount of the transaction. The contract was for $6,000 for 1 year, or 12 months. Polly's Plushies have fulfilled their obligations for 1 month. So we have 6,000 multiplied by 1/12, which is $500. Now that we have all the information needed, we can actually create our journal entry. We start with the date. Because we create the adjusting entry at month end, the date will be December 31st. Next, we list the account debited, accounts receivable, and the amount of the transaction, $500. Then we have the credited account, plus revenue, with its matching amount. The entry finishes with its description that we are accounting for 1 month of unrecorded revenue and the calculation used to find the amount of the transaction. Another form of adjusting entry is an unrecorded liability. A liability can be created before it is paid or even billed. However, all liabilities need to be recorded for the company to get a complete picture of their income and financial standing for a period. As with the unrecorded receivables, some of these liabilities arise from long-term contracts or other liabilities that develop over time. For example, Polly's Plushies pays their employees bi-weekly, but the payroll schedule was such that the employees got paid on December 24th. However, 10 employees earning $10 per hour had to work 40 hours through year end with the next payday to be January 7th. How do we account for these wages? Also, the company took out a $9,000 loan on December 1st that charges 8% interest. The original loan is a straightforward journal entry, but how do we account for the interest built during the month of December? First, let's consider the issue of the payroll. What accounts are involved? The workers have done work, but they have not yet been paid for that work, but they want to get paid. Therefore, the unpaid wage amount goes into the liability account, wages payable. This is matched by wages expense. Both these accounts will increase. Liability accounts increase with credit amounts, so wages payable gets credited. Expenses increase with debit amounts, so wage expense gets debited. The wages are just the amount of the wages for 10 workers at $10 per hour for 40 hours, or $4,000. Now that we have the particulars, let's create the journal entry. We start with the date, December 31st. The debited account is wages expense in the amount of $4,000. The credited account is wages payable with a matching amount of $4,000. Then we have the description that we are accounting for wages earned but not yet paid, and the description of how the amount was calculated. But what about the loan adjustment? Unless Polly pays the loan, the principal amount of the loan stays the same. What is really changing is the amount of interest that Polly needs to pay. As such, the liability account is interest payable, which is matched by interest expense on the income statement. Because the interest builds, both accounts will increase. Liabilities increase with credit amounts, so interest payable gets credited. Expenses increased with debit amounts, so interest expense gets debited. But how much? The loan charges 8% interest, but that is for the entire year. We have only gone through 1 month. To find the amount of interest accrued, multiply the $9,000 amount of the loan by 8%, 0.08, then multiply by 1 over 12. The amount of interest accrued is $60. The date of the adjusting entry is December 31st. The debited account is interest expense for $60. This is matched by a credit to interest payable, also for $60. The entry closes with the description that we are accounting for interest accrued with the calculation of the final amount. One final note: payable accounts are always liabilities. This helps us identify the balance sheet account affected by an adjusting entry. But what other types of adjusting entries are needed to ensure the company has an accurate picture of their financial health? Stay tuned to the next resource in the series.